Companies have poured more than $10 trillion into artificial intelligence over the past 2 years. Nvidia stock skyrocketed from roughly $150 to over $900, propelled by an insatiable demand for AI chips. Microsoft has committed more than $60 billion solely to AI infrastructure. Google, Amazon, Meta, every major tech giant is betting the future of their business on AI. According to Nvidia's CEO Jensen Huang, AI will transform every industry, reshaping everything from manufacturing to healthcare. Sam Altman insists artificial general intelligence is only years away, and investors are acting as if we are moments from cracking the code of a new industrial revolution. But beneath this wave of optimism lies a basic problem almost no one wants to acknowledge. The numbers do not add up. Companies are spending hundreds of billions to develop AI systems, while generating only a fraction of that in revenue. The economic reality simply does not match the narrative. The use cases are limited, the costs are overwhelming, and the revenue model is at best uncertain. The situation increasingly resembles the dot-com bubble, except the scale is far larger. The magnitude of capital at risk this time is unprecedented. This pattern is not new. Every generation sees an emerging technology that promises to change everything. Enthusiasm swells, capital floods, and then stock prices explode. Then reality sets in. The technology proves useful, even revolutionary, but far less profitable than predicted. Companies that overspent collapse, and trillions in market value evaporate. Railroads in the 1800s, radio in the 1920s, dot-com startups around 2000. Cryptocurrencies just a few years ago, technology itself moves forward, but the investment bubbles burst. AI is following the same arc, not because it is fake or useless, but because expectations have reached a level that no business model can sustain. To understand why, start with the spending. The scale is almost incomprehensible. In 2023 alone, companies invested roughly $200 billion in AI infrastructure, data centers, chips, cooling systems, and electrical capacity required to train and run AI models. In 2024, that number climbed to about $350 billion, and projections for 2025 exceed $400 billion. Nearly $1 trillion in 3 years just on hardware and power. That does not even include research budgets, acquisitions, or the massive salaries offered to AI engineers. Nvidia sits at the center of the spending frenzy. The company does not pay these costs. It receives them. In 2022, its data center revenue was about $15 billion. By 2023, it surged to $47 billion. For 2024, projections surpass $100 billion. Nearly all of this growth comes from AI chips H100S and H200S priced between $25,000 and $40,000 each. Tech firms are purchasing these chips in quantities measured not in hundreds, but in tens of thousands. A single training cluster now costs $500 million to over $1 billion, and major corporations are building multiple such clusters simultaneously. Microsoft alone has spent more than $60 billion on AI infrastructure. $13 billion went directly to OpenAI. The rest went into data centers, processors, and cloud systems to power AI services. Google has committed about $50 billion, Meta over $40 billion, Amazon more than $30 billion. Combined, the big five companies have spent well over $300 billion in the past 2 years. And rather than slowing, the spending curve is accelerating. The question investors and executives prefer not to confront is obvious. What are they getting in return? Massive expenditures only make sense if the revenue justifies them. So far, it does not. OpenAI, the company that triggered this wave with chat, currently generates around $3.5 billion per year in revenue. That is extraordinary growth from the roughly $1 billion earned in 2023. But OpenAI is still unprofitable. Compute costs alone, much of it paid to Microsoft, are estimated to exceed $5 billion annually. That means the company loses at least $2 billion each year. Despite that, OpenAI's valuation hovers around $150 billion, an extraordinary figure for a company losing more money than it earns. It is valued at more than 40 times revenue. Microsoft has woven AI into nearly all its products from Office Copilot to Azure AI services to Bing's AI-enhanced search. But the revenue attributed specifically to AI remains murky. Analysts estimate AI contributes $10 to $15 billion annually. That is meaningful. But Microsoft spent $60 billion to build it. Even under optimistic assumptions, it would take 4 to 6 years to merely break even, and that assumes costs remain stable, which is unlikely given rising compute demands. Google's situation is similar. AI contributes an estimated 15 to 20 billion per year primarily through cloud services and AI-enhanced advertising. But Google has spent around 50 billion in AI-related investments. Worse, its flagship Gemini model is free for most users. The company is not monetizing AI so much as using it defensively to prevent erosion of its core search business. Meta integrates AI deeply into ad ranking and content recommendations, which boosts revenue indirectly. But its consumer-facing AI products like the Meta AI Assistant produce almost no revenue. Meta has spent $40 billion not only on AI but also on Reality Labs, and much of this investment has yet to generate meaningful returns. Many of Meta's AI features are simply free enhancements aimed at keeping users engaged, not products that generate subscription or licensing revenue. Amazon relies on AI in AWS, Alexa, and logistics. While AWS AI services may bring in 10 to 15 billion annually, Amazon has invested 30 billion into AI initiatives. Meanwhile, Alexa remains a persistent financial sinkhole, losing billions every year. Adding more advanced AI to a product that already loses money does not transform it into a profit engine. Putting it all together, the Big Five have spent over $300 billion on AI in 2 years. The annual revenue generated by AI across these companies is perhaps 60 to 80 billion, but most of that comes from incremental improvements to existing products. The new standalone AI products, chat subscriptions, Copilot upgrades, AI assistants likely contribute only 10 to 15 billion total. That means 300 billion in spending have produced maybe 15 billion in new revenue, a 20:1 spending to revenue ratio. At that pace, it would take 2 decades to break even, and no tech platform remains dominant long enough for a 20-year payoff window to make sense. And this assumes revenue keeps growing. But what if it does not? What if AI revenue peaks within the next couple of years? What if businesses discover they do not need millions of dollars in AI tools to maintain productivity? What if consumers refuse to pay more than $20 a month for AI assistants? Right now, most AI subscriptions cost between $10 and $30. To generate meaningful revenue, hundreds of billions per year, companies would need hundreds of millions of paying users. But that is not happening. Chat does around 10 million paying subscribers, far short of what is needed to support the scale of investment behind it. Consumers love free AI features. They hesitate when asked to pay for them. The result is an extraordinary mismatch, astronomical spending fueled by fear of missing out, paired with revenue streams too small and too uncertain to justify the investment. AI is real. Its capabilities are extraordinary. But the business models powering it are fragile, and the costs required to run it are unlike anything the tech sector has ever faced. At $20 per month, 10 million subscribers bring in around $200 million, monthly roughly $2.4 billion per year. That accounts for most of OpenAI's consumer subscription revenue, with enterprise clients contributing the remainder to reach an estimated $3.5 billion annually. Yet even with those numbers, the company loses billions. The biggest culprit is computation. Their models require so much processing power that the more successful the product becomes, the more money they burn. Profitability demands either sharply raising prices, which risks driving away users, or dramatically lowering costs, which requires breakthroughs that may or may not arrive. Neither path is guaranteed. Microsoft faces a similar dilemma. Copilot has fewer than 5 million paying users. At $30 per month, that translates into about $1.8 billion a year. Google's AI premium tier lags even further behind with perhaps 2 million paying customers, generating roughly $500 million annually. These figures sound large, but relative to the tens of billions spent on AI infrastructure, they are tiny drops in an ocean of capital expenditures. Worse, subscriber growth across the industry is leveling off. The initial wave of curiosity-driven adoption has ended, leaving a stable but modest user base. New signups now roughly match cancellations, indicating that the true addressable market for paid AI assistants may be far smaller than the hype suggested. Enterprise adoption, often cited as a long-term revenue engine, is also progressing slower than anticipated. While businesses are experimenting with copilots, chatbot, and generative automation, scaling these tools across an entire organization is complex. Integrating AI with legacy systems takes time. Training employees to use it effectively requires money. And many companies discover that AI delivers incremental, not revolutionary, productivity gains. A widely cited MIT study found that AI coding assistants, such as GitHub Copilot, increased developer productivity by about 26% useful, but hardly transformational, especially considering that these productivity gains apply only to specific tasks and often require human oversight. For most companies, that bump does not justify massive investments in custom models or extensive AI deployments. Executives are beginning to realize that AI is more like a powerful new tool than a paradigm-shifting industrial revolution, at least in the short term. Costs, however, tell a different and more troubling story. Training state-of-the-art models is astonishingly expensive. Training a model on the scale of GPT-4 costs well over $100 million just for compute. And the cost of inference, the process of running the model for everyday queries, is even more relentless. Each chat query costs roughly 1 to 4 cents. Individually insignificant, but at billions of queries per month, the numbers explode. If chat processes 10 billion queries monthly, the inference bill reaches between $100 million and $400 million every 30 days. That is 1.2 to nearly $5 billion per year. These operational costs alone can devour subscription revenue. And despite ongoing optimizations, costs are not falling dramatically. Every new generation of models grows larger and more capable. GPT-5, when it arrives, will require more compute to train and run than GPT-4. Google's Gemini Ultra already requires significantly more power than Gemini Pro. The AI industry is chasing ever larger models, and larger models inevitably consume more resources. This creates an escalating cycle. Companies must release increasingly advanced models to stay competitive, but doing so inflates their already unsustainable compute budgets. Then there is the energy problem, an issue that the public rarely hears about, but insiders increasingly fear. Training GPT-4 consumed roughly 50 gigawatt hours of electricity, enough to power around 5,000 American homes for a full year. And that was just one training run. Major labs train multiple models every year, sometimes dozens. Inference also demands massive amounts of energy. A single Nvidia H100 chip consumes about 700 watts at full load. A mid-sized cluster containing 10,000 H100s draws about 7 megawatts, continuously the output of a small power plant. Large clusters of 50 to 100,000 chips require between 35 and 70 megawatts, operating 24/7. The electricity costs alone reach into the tens, or even hundreds of millions annually. Cooling adds another 30 to 50% on top of that. A single major AI data center can cost between $75 and $150 million per year just to operate, and companies are building many of them. As AI infrastructure scales, global energy consumption is skyrocketing. By 2027, AI data centers could use more electricity than entire countries such as Argentina or Sweden. Many regions' power grids simply cannot expand fast enough to meet projected demand. This looming energy bottleneck may become one of the defining constraints on AI's future. The stock market reflects the same tension between bold expectations and fragile fundamentals. Nvidia's share price has risen from around $150 in early 2023 to over $900 by late 2024, a six-fold increase. With a market cap surpassing $3 trillion, the company stands among the most valuable on Earth. But Nvidia's valuation assumes that AI spending will continue expanding indefinitely. If corporate budgets taper off, even slightly, Nvidia's revenue could fall sharply. The company's price-to-earnings ratio sits around 65. Historically, anything above 25 is expensive. Above 50 is bubble territory. At 65, Nvidia's priced for absolute perfection. Any slowdown in chip orders would cause the stock to fall hard, and the slowdown is almost inevitable. No industry can sustain $300 to $400 billion per year in infrastructure spending without generating equivalent revenue. Signs of stress have already emerged. By late 2024, several AI startups began running out of money. Companies that raised eye-popping sums in 2022 and 2023 spent astonishing amounts on compute, data acquisition, and high-priced talent. Now they face venture investors who are no longer satisfied with vague promises about future markets. The new questions are blunt. What is your revenue? How do you get to profitability? Why should we give you more money? Many startups have no answers. Funding has not dried up completely, but it is slowing significantly. The parallels to the dot-com era are growing harder to ignore. Back in 1999, internet stocks soared to impossible valuations. Companies like Pets.com and Webvan raised huge sums despite lacking sustainable revenue models. The Nasdaq hit 5,000 in early 2000, then collapsed to 1,100 over the next 2 years. 78% of its value evaporated. Roughly $3 trillion in market cap disappeared. Only companies with strong fundamentals, Amazon, Google, eBay, survived. Those with hype but no revenue died. AI in 2024 and 2025 looks similar. The technology is real just as the internet was real, but the investments are based on unrealistic expectations of profitability and market size. Investors assume every AI company will eventually find massive paying customers. Most won't. A clear example is Inflection AI. Founded by DeepMind co-founder Mustafa Suleyman, the company raised an extraordinary $1.3 billion to build a friendly chatbot called Pi. It worked fine, but monetized poorly. Users did not want to pay for it. Most AI assistants suffer the same fate: high engagement, low willingness to pay. By 2024, Inflection had spent more than $500 million on compute alone. With limited revenue and mounting losses, the company was effectively absorbed by Microsoft for $650 million, half its previous valuation. Investors recovered only a portion of what they put in. This cycle raised enormous sums, spend it on compute, fail to find revenue, get acquired for parts will repeat across much of the AI ecosystem. And eventually, the bubble pops. It always does. There are 3 typical triggers in financial history. The first is the collapse of a major company. When a prominent institution falls, Lehman in 2008, Pets.com in 2000, it exposes systemic vulnerabilities and shatters investor confidence. In the AI world, this could take the form of a heavily funded startup burning through billions and shutting down, or a major tech company writing off massive AI investments after failing to monetize them. Revenue growth eventually stops, and once investors realize the explosive gains they were promised are not materializing, sentiment reverses almost instantly. We saw an early version of this during the crypto collapse in 2022, the moment the market recognized that mainstream adoption was not coming fast enough. The air came out of the bubble. AI will face a similar moment of reckoning. You will see it first when chat subscriber numbers flatten in a visible, undeniable way. When Microsoft quietly reports that Copilot revenue is falling short of internal projections, and when Google finally admits that Gemini is not generating any meaningful net new income. These acknowledgments will not be dramatic press releases. They will be buried inside earnings calls, phrased gently as slower than expected monetization. But the market will hear them loud and clear. When these signals arrive, investors will reassess expectations across the entire sector. And then comes a third structural problem: costs become unsustainable. AI companies, even the giants, cannot spend indefinitely. When the money tightens, cutbacks ripple through the ecosystem. Nvidia's revenue drops because companies stop buying high-end chips. Data center construction slows or pauses. Hiring freezes begin, then layoffs. The result is a feedback loop, a tightening spiral where reduced spending produces reduced revenue, shrinking market caps, and even more spending cuts. The doom loop strengthens itself. We are not fully in that phase yet, but we are closer to it than most people want to believe. And when the correction finally begins, the crash will follow a predictable pattern. Nvidia will fall first, not because it is a bad company, but because its valuation is the most inflated and its revenue is the most exposed to AI hype. When AI spending slows, Nvidia stock will be hit hardest. A decline of 50 to 70% from peak levels is entirely plausible. A collapse from around $900 to roughly $300 or below would instantly erase around $2 trillion of market value. The major tech giants Microsoft, Google, Meta, Amazon will also decline, though less violently. Expect corrections of 20 to 40%. These companies will remain powerful, but their AI divisions will be forced to recognize tens of billions in impaired assets. Some of their data centers, built on optimistic assumptions about demand and utilization, simply won't generate the returns that were forecast. For AI startups, the situation will be far worse. Roughly 90% will fail. Only the small minority with real revenue and genuine paths to profitability will survive. The rest burn through cash and vanish. Employees lose jobs and billions in venture capital evaporate. Although this seems extreme, there is precedent. From 2000 to 2002, hundreds of internet companies died. Trillions in market value disappeared. The industry collapsed, consolidated, and eventually reemerged stronger, but built around only a few true winners. AI will follow the same arc. A handful of companies with durable advantages and real monetization may emerge as leaders. OpenAI might be one, if it manages a transition from explosive growth to sustainable profitability. Anthropic could be another, provided it solves the scaling problem. Google and Microsoft will survive no matter what because their business models are diversified and not solely AI dependent. But most of the startups building chatbots, image generators, productivity tools, and niche AI applications will simply run out of room, out of capital, and out of time. Some argue this analysis is too pessimistic. They imagine scenarios where AI discovers enormous new revenue streams, where enterprises finally pay billions for AI automation, and where consumers subscribe to multiple AI tools the way they subscribe to streaming services. That is possible, but unlikely. The reality is that use cases are narrower than the hype suggests. Yes, AI can write emails, summarize documents, generate code, create images, and answer questions. But once a user has one AI that can do all those things, the incentive to subscribe to four others is weak. The market naturally concentrates into one or two dominant providers. On the enterprise side, the story is similar. Most companies do not need custom AI models. They need integrations with existing software. And integration work is services revenue, not product revenue. Services do not scale. Each deployment requires customization, meetings, testing, and maintenance. There is nothing infinitely scalable about that. Even optimistic adoption does not justify the infrastructure boom. People also argue that AI costs will drop. Compute improves, efficiency rises, hardware advances. But the improvements are not arriving fast enough. Nvidia's Blackwell chips are more efficient than the H100S, but also more expensive. Net cost reductions of 20 to 30% per query do not solve the fundamental economics. Larger models GPT-5, GPT-6, multimodal systems consume those efficiency gains and exceed them. The computational appetite grows faster than the hardware savings. Then there is the AGI argument. If artificial general intelligence becomes real, the market potential becomes theoretically unlimited. Every cognitive job could be automated. Trillions in labor costs could convert into AI revenue, and entire industries could reshape around autonomous digital workers. But two problems stand in the way. First, we are nowhere near AGI. Current AI is narrow, specialized, and incapable of genuine reasoning, long-term planning, or contextual understanding. AGI could be a decade away or half a century. No one knows. Building trillion-dollar expectations on a technology that might not arrive in the next 2 generations is financially reckless. Second, even if AGI emerges, the economics are unclear. If AI replaces millions of workers, who pays for its services? If human income collapses, demand collapses with it. This is the automation paradox. A technology that eliminates jobs destroys the very markets it depends on. AGI could trigger a major economic restructuring, not a profit explosion. So, what should investors do? Many people have exposure to AI stocks, some directly through Nvidia, others indirectly through tech-heavy index funds. My analysis, not financial advice, is that AI equities are overvalued and overdue for correction. If you hold Nvidia above $700, the risk is significant. Consider taking profits. If you bought earlier and made large gains, preserve them. Corrections in overinflated markets tend to be brutal. Owning big tech is safer, but not fully safe. Expect valuation compression. Decide whether you can tolerate a 20 to 40% drawdown. If not, reduce exposure. If you have invested in AI startups through venture funds or SPVs, recognize the reality. The failure rate is extremely high. These are speculative bets. Only invest what you genuinely can afford to lose. For most people, the wisest approach is a gradual reduction in AI exposure, diversification into less speculative assets, and patience. You do not have the time to top perfectly. You just need to avoid riding the bubble all the way down. When the crash arrives, it will create opportunities. But those opportunities come after the decline, not before it. Here's the likely timeline. In 2025, AI spending continues but grows at a slower pace. Instead of 50% year-over-year expansion, we see 15 to 20%. Investors are disappointed, and stock prices soften. By mid-2026, major companies begin reporting that AI revenue is falling short of projections. Write-downs begin. Nvidia falls 40 to 50%. By 2027, the bubble has clearly burst. Startups collapse at scale, valuations plunge, and the hype cycle flips into disillusionment. Consolidation begins. This is the bottom. By 2028 or 2029, the sector stabilizes. The survivors have real economics, real revenue, and legitimate business models. AI becomes a normal, essential part of the economy rather than a speculative gold rush. But the total market value is far smaller than the peak. Instead of $10 trillion in AI-related valuation, maybe $2 trillion remain. The rest simply disappears. This is how technology bubbles behave. The technology is real, but the expectations become fantastical. The crash removes the excess. The survivors rebuild on realistic foundations. A decade later, the technology is everywhere but no longer glamorous, just infrastructure like databases, cloud servers, or networking protocols. 10 trillion invested, 60 to 80 billion in annual revenue. The math never worked. The costs are too high, the margins too thin, the use cases too limited, and the valuations too perfect. This is a bubble not because AI is fake, but because expectations are impossible. And when expectations collide with reality, reality wins. The crash is coming. The only question is whether you will recognize it before it happens or after.